Good afternoon. It's Jeffrey Christian of CPM Group. It's about 10 minutes after 12 noon here in New York on Tuesday, the 19th of November. Gold's trading around $2,630. It's up $15. It was up more earlier today. It's flopping around. Silver's around $31.24. And platinum and palladium are both up. Palladium more than platinum. I want to talk about a variety of topics today: gold and silver, also U.S. budget deficits and debt, and U.S. coal, oil, and gas production. There's a lot of things happening in the world, and we've been talking to our clients about what is happening and our analyses of these things and what they may mean for gold and silver markets and platinum group markets over the last several weeks and days, and it's going to be an important time to see, because there are probably some major changes occurring in the political and economic environments that affect these markets. So that's what we're going to do. I want to start by updating. I used this chart last week, and I was talking about how the world is not dumping U.S. Treasuries, and in fact, U.S. Treasuries holdings overseas by either foreigners or U.S. entities of U.S. Treasuries actually rose 10.5% last year to a record $8 trillion. We got some data this morning or yesterday that updated it through September of this year. At the end of September, overseas holdings of U.S. Treasuries were $8.67 trillion. In September alone, they rose $170 billion. So overseas investors are not dumping U.S. Treasuries. They're not dumping the dollar either. The world is turning to them, as it is turning to gold and to a lesser extent silver, expressly because of the tremendous uncertainties that you're seeing around the world right now. Anybody who tells you that the world's dumping dollars is trying to sell you something. I'm going to talk about a little bit about speaking from a position of knowledge. We often hear people talk about something or someone, maybe even me, and they just don't know what they're talking about. And they probably shouldn't speak about it until they've learned something to know. Now, to be fair, if I speak about the Hungarian government and someone who's a Hungarian expat criticizes me, what do I know about the Hungarian government? I guess I owe it to people who are listening to me, since I'm speaking about it, to say something about what my background is. Some of you who have been listening to these videos over the years or otherwise know me know that I studied international politics and journalism in university. And in international politics, I was specializing in communist regimes and in international economics, and how communist countries in Eastern Europe, Soviet Union, China, and elsewhere traded internationally, as well as developing countries. So I studied a lot about Hungary in university, and after that I continued to read. In addition to that, I have worked with the Hungarian government from the 80s until around 2010. So I worked with the Hungarian government when it was a communist regime, and I worked with the Hungarian government in the 10 or 20 years after the communist regime fell and it became a democratically elected government. So I do actually have some insights into Hungary, as I do in other topics that I've studied. And I think that I owe it to people to explain that so that they know I'm not just one of those people on the internet blowing it out. Here's our intermediate term gold recommendations. These are for investors with a 1 to 3 year time horizon. We started keeping track of them in December of 1980. And, the red arrows are when we said, hey, you should sell your gold or even short gold. And the green ones are where you should cover your shorts and buy gold. You can see from 1980 until 2000, it was back and forth. And about 68% of the time, I believe, or maybe 64% of the time, we were telling our investor clients, don't buy gold. If anything, short it. And we did pretty well, and they did pretty well about that. In November of 2000, we issued a buy recommendation. We said that there were major changes coming economically and politically that would lead to an upward shift in the investment demand curve. More investors would buy more gold for a longer period of time at higher prices than ever before. That has, in fact, happened. We kept that bold buy recommendation in place until the end of 2011, the first week of January 2012. We issued a report titled A Time to Sell. The price was about $1,600 at the time. In 2014, we issued a buy recommendation, a little bit premature, and that buy recommendation is still in place. So when people who don't know the history of CPM Group say, oh, geez, maybe they're becoming bullish, maybe we became bullish in November 2000 and you just weren't listening. Similarly, in silver, very similar pattern, back and forth in that period from 1980 to 2000, 2001. Around 2001, we said that we thought that the market was changing. We were seeing less disgorgement of old silver by investors, and we saw a trend going toward what we expected to be net purchases by investors, which emerged around 2005. We kept that buy recommendation until the last week of April 2011, when the price on an intraday basis approached $50. We kept that sell recommendation that we put on in April of 2011 in place until 2019, when we put in a buy recommendation. And that's been in place ever since. I want to run through some numbers on the federal budget deficits. You can see they've gotten pretty big. The Congressional Budget Office projects that we will have deficits, budget deficits, annual budget deficits, ranging from about $1.8 trillion per year to about $2.8 trillion per year over the next decade. And that was before they took into account some of the changes that may happen. Now, we've been being asked what we thought a Trump administration and a unified Republican government might mean for the U.S. economy, the budget deficit, debt, and other factors. And we keep saying it's really too early to tell. You can see some things, but it's too early to tell. And the comments that have been made by President-elect Trump and his associates are internally inconsistent. So you can take some of the things they've been saying and say they are going to be extremely contractionary. They're going to slash the budget, slash government spending, and that could accelerate, bring forward, and make deeper a recession. CPM Group is still projecting a recession sometime in the next 24 months. It could be deeper and sooner, depending on a number of factors, including what a Trump administration and a unified Republican government does. Or it could be extremely fiscally stimulating. You can see here the red parts are Republican administrations, and you can see that the budget deficits tend to grow sharply under Republican administrations and tend to contract under Democratic administrations. The last surpluses we had were the last 4 budgets of the Clinton administration. Prior to that, the last surplus that we had was the last LBJ, Lyndon Johnson budget in 1968. Democrats are the party of tax and spend. Republicans are the party of borrow and spend. It's just an economic reality. Don't blame me. I'm just pointing it out. And it's not my data, it's actual real data. And you can see that the CBO basically says our baseline is regardless of who is president, we're looking at massive deficits as far as the eye can see. You know, the last, at the end of the Trump administration, or George W. Bush administration, and I should point out, the last time we had a unified government under Republicans was 2003 to 2007. That was an era of um, sharp growth in no detail mortgages, collateralized mortgage obligations, collateralized debt or obligations. It ended with the recession of 2007 to 2009, the global financial crisis. Something like 30 million Americans lost their homes in the mortgage scandal. $7 trillion of investment money was lost in the Great Recession and global financial crisis. And the US government poured several $1 trillion into banks to shore them up, even though various people ranging from Alan Greenspan and Paul O'Neill, two previous Treasury secretaries, one both under Republican administrations, and Sheila Bair, who was the head of the FDIC, said, look, we can stabilize the mortgage market for about $200 billion. Once you stabilize the mortgage market, then you can value the derivatives written against those mortgages, and then you can know if those banks are solvent or not. But rather than follow the nomenclature, stabilize the base so you can value the derivatives so you know what the owners and holders of those derivatives are financially in shape. They chose to pour trillions of dollars into those banks. So it wasn't a good ending for a unified Republican government. We did have a unified Democratic government for a few years under Clinton, and it helped contribute to that increase, the emergence of surpluses and the paying down of about $1 trillion in debt. Although I must say, most of what happened under Clinton that allowed that was with a Republican Congress that worked with the president. It worked so well with the president that we started turning a surplus, and certain Republican leaders told the other Congress people, we must stop cooperating with the Democrats because they're getting credit for the work that we've done with them. And that, to some extent, was the beginning of this hostile relationship we've had. The old time Democrats and Republicans that actually worked with each other to try to solve government problems. And when I say government problems, I mean problems that the government has created that they then go out to solve so they can go off and get reelected on the basis of the fact that they solved the problem that they originally created. Those days are gone. We might be able to get them back. It's hard to tell. It's too early to tell for sure. This is the budget deficits. The result is a budget debt, total debt, which here is at $35 trillion. This is, I'm not sure what the end date is. I believe it's more than $35 trillion right now. And you can take that and you can break it down by presidents. And you can see deficit spending and the rise in debt is shared by everyone, Democrats and Republicans. Again, Republicans tend to borrow more the government tends to borrow more under Republican administrations. But the problem has been universal really since 1980. In 1980, we had a budget deficit of $58 billion and total debt of $1 trillion. Now, coincidence is not causality. You have, in order to assign cause accurately, You have to analyze what's causing things very carefully. And people tend to not do that. But I'm sure a lot of people will have some knee jerk reaction to my comments in this video and say, oh, you're being a Democrat, or what do you know about finance and all kinds of other things, because they only know how to react on a knee jerk basis. You have to be very careful. The reality is that the president and Congress are not responsible for a lot of things that occur in the United States, in the US economy, and in the world. Right? I'm going to show you some coal and oil production stuff. Just because coal production and coal employment and oil and gas exploration and drilling fell during the first Trump administration, it doesn't mean that it was his fault. In fact, it wasn't his fault. It was trends in those industries that predated his presidency and postdated his presidency. Now, there are times when the government's responsible for things, or it does have an effect on trends that exist beyond the government, or it's the outright cause of things that happened. But you have to be very careful in analyzing things. We try to be careful at CPM Group, and we hope that our listeners and readers are too. This is U.S. coal production. It has fallen due to coal market trends, not because you had a Democrat or a Republican administration. And you can see that the peak was around 2008, kind of plateaued a little bit lower than that for the next 6 years, and then it started declining. It started declining because of issues going on in the coal markets. We've highlighted the 4 red years of the Trump administration because he had said that he was going to rejuvenate the coal industry, and he didn't, which is a very important thing to remember when you start talking about what might happen in a second Trump administration. Although I must say, a second Trump administration is going to be radically different from the first Trump administration and from previous Republican administrations. He's talking about closing the board of the Department of Education. It's very funny because in 1980, Ronald Reagan ran on a platform that included a plank that said he would close the Department of Education. The Department of Education had a budget of about $14 billion in 1980. After 2 Reagan terms, 8 years, the Department of Education's budget was something like 67% greater. By the end of the George H. Bush term, so 12 years of that government operation, the budget of the Department of Education was about $32 billion, more than doubled what it was when Ronald Reagan said that he would close it. And they had built a new headquarters for the Department of Education on the Mall in Washington. So sometimes governments promise things and then they don't deliver. Sometimes they don't even try to deliver. Sometimes they try to deliver but fail. There's all kinds of things, and you have to very carefully analyze it. This is coal industry and employment. Similarly, you've seen this decline. Similarly, the decline started around 2013. Similarly, the decline did not necessarily reflect anything that the U.S. government was doing, administration, Congress, or other people, the Department of Energy. It had to do with trends in the coal industry and coal market. And it was occurring on a worldwide basis. And these are oil and gas drill rigs in operation. You'd see that they fell sharply a long, long time ago. They started to rise after 2000. There's a good correlation to some extent to changes in oil prices and gas prices and levels of oil and gas prices and the amount of drilling that occurs to find new oil and gas. We saw it pick up, by 2000, the price of oil was down to $10 a barrel, and natural gas was about $2 per million cubic feet. You started to see oil and gas prices rise after 2000, and there was an increase in drilling. It was interrupted by the Great Recession. It came back after the Great Recession, and it was kind of plateauing until around 2015. Since that time, it's fallen off sharply. So the drill baby drill dream just didn't occur. What does all this mean for the US economy, global economies, the dollar, gold, silver? It's too early to tell. Beware of people who tell you otherwise. If somebody can tell you with great certainty what this administration is going to try to do and what it's going to succeed to do and what its implications are for economic trends and precious metal prices, be very suspicious of that person because, as I said, there are internal inconsistencies in what's being said, and it's not at all clear what all can be done. And there are many other players and agents and entities acting on their own, and there will be an interaction between what the US government does and other governments and corporations and individuals. So we've gotten rid of one uncertainty. We know what the presidency is going to be, and we know that we're going to have a unified Republican government. But that opens up an entirely new set of uncertainties that are going to cause investors pause. And when they're uncertain and when they're concerned about where the economies are going, they buy the US dollar, they buy US treasuries, they buy gold, and they buy silver. So we're pretty bullish on gold and silver going forward. Now, gold and silver prices fell sharply over the last few weeks. They started to fall on October 31st before the election. You have heard people say, well, there's some economic euphoria that has pushed gold and silver down because the risks of economic catastrophe are reduced with the Trump imminent presidency. That's not true. Gold and silver prices fell sharply starting October 31st before the election. So too did copper, aluminum, oil, gas, platinum, palladium, and other commodities. All of them, or most of them, had seen very sharp increases in prices in the preceding 3 or 4 months. You could see from this chart here, gold prices rose very sharply and very consistently from $2,300 at the end of June to $2,800 on the 30th of October. And you had people who follow these markets closely saying this market is overdue for a downward correction. There's got to be profit taking. And throughout the period of July, August, September, October, we saw very well educated, some of the best analysts in the oil and gas, the gold and silver markets saying, look, institutional investors have gotten so long on gold, they can't add to their gold positions. They have to stop buying, if not actually liquidate and take some profits. And institutional investors kept adding to those long positions into early October. In gold, in silver, in all those other metals, in industrial commodities, oil and gas. And then starting in late October, there was a round of profit taking, which cascaded. The election, no doubt, helped accelerate that decline. But the decline was in all of these industrial commodities as well as gold and silver. If it was economic euphoria, maybe you could justify gold and silver prices falling, but you can't justify industrial commodities falling sharply in price based on the idea that economic conditions will be better. If you think economic conditions will be better, you would think that those commodity prices would rise. Simple logic, right? So the declines did not reflect economic euphoria. They really reflected profit taking after several months of unbridled price increases, in some cases, such as in gold, to record levels. Our expectation is that gold prices will dust themselves off and probably move to new highs between now and January over the next 3 months. After the first quarter, we think gold prices may plateau and come down a little bit, but then we expect them to rise further in the second half of 2025 and into 2026, possibly reaching a cyclical peak in that period of time, depending on what's happening economically and politically. And very similar situation in silver. We saw the silver price, which has sort of been more tempered than gold, continue to rise sharply from August through August, September, and October, peak a little bit before October 30th, and then come down. I showed you a chart, I think it was last week in one of our videos, where I had the surplus and deficits of silver projected through 2027. That was from a special report that we did, which is available on our website for free, called The Real Reasons to Own Silver. And you should see that, and you should, we did it sponsored by Silvercorp, which likes to see good research on silver promulgated through the market. You can get that probably from Silvercorp's website as well as our website. And we have a webinar that we're doing with Silvercorp next week on that very subject, where they will sort of review the stuff. Now, that chart that I showed you had projections of our surpluses and investment demand levels to 2027, but it did not have price projections. And some wag complained, oh, we must not have price projections to 2027. We do. We have quarterly price projections out 8 quarters, so into late 2026. They are available on our Precious Metals Advisory. And we have annual projections for silver prices going out 10 years. And we sell those to our clients. And anybody who really wants to know what we're thinking can become a client. I think that's about all I've got for today. Sorry I went a little bit long, but there was a lot of ground to cover. I left off several things that were in my punch list of things to talk about. Russia, China, Peru, new Chinese ports in Peru, and other issues. But we've already gone long enough. You may go to our website. You can get that silver, the real reasons to invest in silver report off of our website. You can probably find a place to sign up for that webinar next week. You can find other things that you can buy, or you can have a number of free reads and videos at our website. And you can always send us an email at info@cpmgroup.com about asking us how we can help you invest better and more wisely, and perhaps even more profitably in precious metals and commodities. Until Friday, take care of yourself, take care of those around you, try to do something good for the world, and we'll see you then.